things start not to make much sense to invest still into the stock market if interest rates were at 5, 6, 7, 8, 9, 10% interest rates. So they're kind of holding the line at the moment, or the market is. I don't know who's doing it, but if that breaks down and rates go up, okay, we'll see what the reaction is. If they say, well, we're gonna bring it back up here, printing billions and trillions of dollars, they're just going to tank the dollar then. They're just going to put the relief valve and say, open the spigot, we're going to drop this sucker. And what have they been saying? What does Trump always say? I think we need a weaker dollar. It's almost like they know that they have to do this.
Welcome to CapitalCosm, everybody. It is July 29th, 2025, and my guest today is Andy from Finding Value. Andy, thank you so much for coming on the show, my friend.
Yeah, thanks for having me on, Danny. Really appreciate it.
Yeah, likewise. Always a pleasure having you on, Andy. The audience loves you as well. So let's go ahead and dive right into what you're looking at right now. What is your main focus right now? What do you think investors should be most fixated on given the current market conditions?
Yeah, I like everything that's down. So I'm not chasing things. Things are down, bottoming patterns. I'm seeing a lot of bottoming patterns, I would say, across the inflation sensitive stuff. I know it seems a little bit different. Gold's already ran, it's had a big move. Silver's sitting on top of its kind of breakout pattern. I still think that looks really good from the long-term perspective. Copper's looking fantastic. That's broken out. It's sitting on top of its big structure. I think lithium, iron ore, fertilizers, oil, everything looks really good. That's inflation sensitive. They're bottoming out. Usually gold runs first. A lot of people say copper runs second, which it's all lined up and teed up to do that. And then next, after that, will be your energy, like oil, natural gas, and stuff like that. So they're kind of still consolidating oil and nat gas, but I think they're going to have really, really good futures ahead of them for those sectors. So those are all of them: steel, iron ore, all that stuff.
Yeah, so I see you've got a chart here of gold. Do you want to walk us through what you're seeing going on with the gold price?
Yeah. So we'll start with gold. So generally, you get these consolidations. Like this is a consolidation here. We call that the cup and handle. I'm sure everybody's heard this a billion times. And then you get the big breakout, right? So the structure, which is all that, or the consolidation, creates basically the foundation for a big breakout. Gold's our leader, so it created that foundation, that base. It broke out and it ran quite a bit. So what I generally do is I look for things that are close to like sitting on top of a pattern before a breakout. I don't really chase stuff that's already broken out, like gold, for example. So I go around and I look for these big kind of consolidation base areas. So things that are creating those big consolidation base areas, this is silver. And then I just take a big picture view of silver, and then it's a little easier to see. And then I kind of zoom out. So if you saw gold, you had that big breakout after the consolidation. This is your consolidation here. And we're right trying to break out here any second. I mean, it could happen. I don't know when, but it'll happen any second. But this is your big consolidation. You're going to get a big breakout. And when you break out of these big consolidations, that's when they typically run a whole bunch. So I am very bullish on silver because of the consolidation, the potential breakout. Copper is another one where we get these large consolidation structures, this is the whole consolidation structure there that we've broken to the upside. So when you break these consolidations like this one, you get these big runs. It doesn't mean that it will happen immediately. Like this one here, it kind of broke out of its base almost and consolidated sideways for a little bit there. That took about February of 04 to May of 05. So it went sideways for a little bit before really running. So I'm not stating that this is going to happen immediately. What I'm stating is the structure's broken, and this is where you want to take advantage of it because you're more than likely going to see a big run out of copper. And the bigger these patterns are, the larger that they will run. So just to show you kind of herd psychology, this is just an imprint of the herd's psychology. So I'll just kind of copy this, and then we can literally just move it over. And it's the same pattern. It's not perfect, but for the most part, it's the same pattern that repeats. And this portion here, I'm just going to move it over. This little kind of consolidation there is that consolidation there. So what comes next is going to be more than likely a big kind of vertical move that occurs in copper. So what I'd be doing, I'd be going and looking at copper, potential investments in copper, and worrying less about talking about the bull market and more about getting active and looking for potential investments that could benefit from a move in say copper here. There's other things that look good too. Obviously, I'll touch on crude oil. I really like, let's do US oil. I just like the big long-term picture of it. Let's do this. And again, I run a lot of it off the fractal. The fractal is just a repeating pattern that occurs over and over. We're right there sitting on top of a potential breakout. Now that circle is where I think the circle is of last bull market. If you run across the top, this is the cross the top there. So we're still very early in a move that I think is coming that's going to be quite large. I know people want to put narratives to this. They want to explain it through a story. I know people grab onto that, but I look at things through charts. I add all the charts together and I create my quote narrative. So whatever's coming in oil, it's going to be big, just like copper, just like silver. These are all interconnected. And again, they're connected through a weakening dollar is what I think is going to really push all this higher. Iron ore. Iron ore is another one that I think looks really good. So we can look at this one here. Get off logarithmic there. So iron ore, I think this could be a Livermore accumulation cylinder. 1, 2, 3, 4, 5, 6, 7, and we're at the bottom of 7. So I think that's a really good opportunity if you go and potentially look at some steel and iron ore companies. They look pretty good, like they're putting in bottoms ready to turn higher. So I think iron ore with some time will do very well, is what I'm seeing. So this would be an early one to be looking at as well. I think I'll just keep going. Rare earth metals. This looks fantastic. I like looking at the candles here. Nice kind of bottom going on here. It's starting to break out of a downtrend breakout. We're starting to break through this horizontal resistance line. We'll probably maybe do a retest here back to about 48 before heading higher. But this looks really good, really promising for a long-term investment. REMX and what's in this ETF, I'm just using it as a gauge of what rare earths are doing. But they have a lot of lithium companies in it as well. So I also think lithium looks quite good at this time. Another kind of potential Livermore accumulation cylinder. We're at the bottom, doing a double bottom right now. Broken down trend, squeezing up into a falling wedge. There's the double bottom. We haven't quite broken out of the vertical horizontal like rare earths have. But this looks really good for something to put on the radar for an early mover here. So there's a lot of opportunity out in the market right now, and some of these sectors have companies that I think could really go. I mean, really move when they get moving in these sectors. So some sectors, they're bigger companies, they don't move as much. So expect out of the bull market, say a 3, 4, 5x, something like that. In some of these, like lithium, maybe even iron ore and steel, last bull market, we saw 40, 50, 100 times your money during the bull market. So it was constrained to 98, 99 into 2008, that rough top area. They moved that amount. So
Wow.
there are opportunities out there where I call it decades can happen, decades of returns can happen in short time frames. And that's why I'm so drawn to some of these sectors that maybe not a lot of people really talk about. But when I looked at last bull market, I saw
Well, when was
that
the last bull
steel.
market? Are you referring to 2020 or the 2011 bull market?
The bull market that lasted from 1998, 99 all
Oh,
the way to 2008 for a lot of the commodity companies. 2011 was the precious metals that kind of went all the way up into 2011. But yeah, 2011 was the top for certain commodities. Other ones they didn't reach their full
mhm.
all-time highs there. So I just took 98, 99 to 2008. I did a study, and what the study entailed was basically looking at how to set up a portfolio, and would it be better to take less risk and go into the larger companies like a Chevron or a ConocoPhillips or a Cameco or something like that, and create a portfolio of all those big ones? Or would it be more advantageous to go into the smaller companies, like the small mid cap type companies that are still cash flowing, not the
Mhm.
speculative stuff as much, and see what the returns would be? And then what I did is I took some of the larger returning companies and said, nope, I'm going to take the top 5 companies out of 10. I took 10 companies, ran the numbers, 10 companies, ran the numbers. And I said, let's take the top 5 out of the smaller and mid cap companies and put it to zero. The top 5, not the bottom 5, the top 5.
Mhm.
And as long as they were cash flow companies, the portfolio still outreturned the larger, more conservative companies with only 5 of the bottom picks in the bull market, last bull market. So the returns on an annual percentage basis beat the large cap companies 10 for 10 versus 5 for 10 of the companies that I had randomly selected. And then you want to look at, what of the larger returning companies, some of them returned over 100x. Um, and I took those out doing the comparison. With them put in, your annual compounded return of randomly kind of generated companies, I was getting between about 40 something percent per annum all the way up to almost 60% per annum of the entire bull market in commodities. Now, that doesn't mean that every year you got that return. Some years you got like 100, 200% return. Other years you were under that, vastly under that, because it was in a consolidation during some of those times like 2000, 2001. So I thought that was kind of interesting going through all that data that I put together of what I would consider companies that exhibited traits that I would have been invested in.
And was this dependent upon like a particular sector, or is this with respect to the lithium sector, or just commodities in general? Like, what sectors was your study run on?
Yeah, so what I did is I grabbed a few of each sectors. So I grabbed a bunch of steel, energy service, energy, home builders, um, anything that would do well in the commodity bull market. I had a couple of uranium companies, and I kind of just randomly selected more of the cash flow type companies and put them together, and to show people, at least on for the website purposes, to show them the strategy and why it works. And I think that is where a lot of people, like, the light bulb went off, like, oh, now I get what he's doing. And you don't have to be 100% successful in deploying it, because you're always going to have maybe a dud or two. It's what happens. So I said, you know what? What if I just took the top 5 out? What would your return be? And it still did very well. Still beat the kind of slow, steady, major diversified mining companies. It beat all those. So not saying that you shouldn't have those in your portfolio at all. It's just, it's very good to have some of these smaller mid cap type companies that can really boost the portfolio, although there might be a lot of volatility because they do go up and down quite a bit. So it's knowing the game that you're playing, and it's knowing that how to play the game, and what strategy works really well at playing that game.
I see. So, Andy, I want to ask you a question here. We touched on gold at the
Sure.
beginning of the show. Here is a monthly candlestick chart of the gold price. However, what you're looking at here, you see these large wicks over the last 4 months here, trying to break out of this $3,500, $3,400 zone. But you've had 4 consecutive failures so far in the gold price, and taking into account how much it's risen over the last 18 months, are we in danger of seeing some sort of reversal to the downside on the gold price, and then therefore seeing that reversal play out in some of the other commodities and precious metals as well?
Yeah, so we're up against resistance. That's what those wicks mean. We're getting selling pressure. So usually you get rejected, it comes back, rejected, comes back, just like he described. So there is selling pressure up there. It doesn't mean that we're going to just beeline it lower or anything like that. We're just up against resistance, and we're consolidating sideways. A lot of the times during bull markets, you consolidate over time more so than through price. So there's a possibility that we go sideways for a period of time, very similar to August of 2020. So if you were to look back at August of 2020, which is a little ways back, we consolidated sideways in time through a pretty large consolidation in gold. 2020 all the way to the bottom of 2022 is where it bottomed. And it created a big consolidation pattern sideways. Yep, that's where it is. It's that whole consolidation sideways. And that's when oil ran quite substantially. So what could be occurring, and I don't know with 100% certainty, is that gold is our leader. It ran, now it's consolidating a little bit sideways, and it might be time where these inflation sensitive assets start to take off. The oils, copper, silver may take off, and they kind of run after gold. So that's kind of what I'm seeing in the charts, is that iron ore and all these other ones, we could
Mm-hmm.
start to see this all firm up and start to run.
Yeah, this is what you saw. So you've got the blue line here. This is a Thomson Reuters commodity index. And as gold began to consolidate sideways, that's when you started getting a bid on commodities.
Yeah, we're seeing that same thing happen right now. We are seeing a move in fertilizers, which is a very inflation sensitive asset. And gold kind of ran first. Then you start to look, because people are going to start to position into some of these equities before gold completely peaks out. And then it starts to kind of head up a little bit before gold peaks, which is kind of what we're seeing right now with your CRB index there. It's starting to already turn higher, getting higher lows and higher highs.
Mm-hmm.
Yep. So we could see this take off to the upside here. So
Interesting.
that's kind of where my thought is. So rather than going and trying to chase gold, you want to go look at the stuff that's lagged behind it, and buy what's down, that's breaking kind of bottoming patterns. And we're seeing a lot of bottoming patterns across the board. Fertilizers, coal, rare earths, lithium looks good, and lithium was very inflation sensitive too, as inflation works its way through the system.
Right. Here's your coal chart.
Yep. That's what I like, when things are down and they're starting to turn higher.
Looking to invest in silver or create something unique? Go to firstmint.com and use the promo code CAPC. First Mint offers premium 0.999 plus silver bars and coins, perfect for stacking or gifting. Plus, they specialize in custom minting for businesses and events. Great for celebrating milestones or promoting your brand. For quality silver and trusted service, visit firstmint.com and use promo code CAPC and make your mark today. Once again, that's firstmint.com. Promo code CAPC. And while you're there, check out this great deal ongoing now.
If you were to price, like say, Newcastle coal against gold, it looks pretty good, and that's a retest too. If you draw a line going across, it's a retest of a breakout. And then, yeah, look at the overall level there in relationship to gold. That's where your value's at if you were to take the dollar value out of it. So that's where I would be getting more excited, is when you get down to those levels like 2020 back there. That was an incredibly good opportunity, and a great opportunity today.
Mm-hmm. I mean, yeah, look at all these green candlesticks that you saw on the way up. I mean, it's pretty much
Yeah.
90% green candlesticks. And then on the way down, it's all red. But what you noticed in 2020 is that the bounce up was a lot more prominent. You had bigger green candlesticks. But this time around, it seems a little weakened. Is that a cause for concern?
No, what I use for the ratios is more of just an absolute value. So I know that coal, at least thermal coal here, is cheap, and it's the level as well. So is the price underneath the cost curve, and how cheap is it? And I use I'm a hybrid. I call myself a hybrid investor. I use technical analysis, yes, but I also look at the valuation component. So when valuations get this cheap, it can get cheaper. I'm not saying it can't,
Mm-hmm.
but I start to get really excited because this is where the value's at in the market. Everyone's dumped coal, and in relationship to gold, this is a very cheap price. Now, also, when I look forward, I try to marry this with more of a fundamental analysis than just technicals. What's coming forward? Do you see increased electricity demand? I mean, that's really what thermal coal, thermals, heating and electricity and stuff like that. So uh, I think we're gonna have to burn more coal. I don't think we have the expansion capacity necessarily in, say, something like nuclear. We can't grow it fast enough for the electricity demand. Uh, Coal is growing rapidly over in China and India. And with artificial intelligence coming, if we want to get away from oil and transportation, fossil fuel based transportation, it's all electrical based. So if we're going to grow electricity, where's it going to come from over the next, say, 10 years? Uh, I think it's going to be, I think coal is going to play a huge role in it. And with coal where it's at and how cheap it is, that's screaming asymmetry all over it. Yeah, you're comparing the fractal of last time, and it's
Mm-hmm.
probably pretty dang close.
Yeah, kind of. Yeah, so
Yep.
the downward pattern is very similar. So the last one from down here, that's the last leg down from
Yep.
the most recent one. There's a pretty decent matchup. Not perfect, but you can definitely see the similarities.
Yep. Now, if we get a move like that to the upside that you're showing there, which I think is a high probability, like I think something like that could occur. This is a ratio chart of coal versus gold.
Mm-hmm.
Uh, the price move of coal would be very dramatic if that were to occur, because I don't think gold's going to go down very much. I think it's coal going up very much. So if we get a move like that, the companies are going to make ludicrous amounts of money. And the reason that I could almost kind of put this to a narrative is we have, Trump signed some stuff basically saying coal's fine, kind of reversing the whole green narrative, we'll say, so to speak. And if we squeeze the AI guy, if the AI guys squeeze energy, I mean, they're going to burn whatever they can. They're
Mm-hmm.
going to burn whatever they can. They're going to
Yep.
burn natural gas. They're going to probably squeeze natural gas, and then they'll squeeze coal right behind it. And coal's kind of that swing producer of electricity. So I think coal's very well set up for the future here, based
What about
off of its
natural?
valuation.
What about natural gas? Do you play around with natural gas at all?
Looks a little bit weak in the short term, but yeah, natural gas looks great on a longer time frame. So nat gas has been uh, trading underneath resistance, and I don't know if you want to pull that up or if I can.
Yeah, go
Um,
ahead.
yeah, I can do that real quick.
Yeah, so
It's it's it's
I'm looking at the
mhm.
chart right now. I mean, it is. I mean, at first glance, it looks just like you're looking at noise. Like it's just all white noise. There's no real trend or pattern to it.
Yeah, so this is what I see, at least in the trend. We've got a downtrend going from this was kind of like the last bull market. So this is the beginning of the bull market there, and this was kind of
Mhm.
the end up here. This year is 2005. That there is 2008. So this is two kind of peaks or tops. We went into a large bear market there, and I think that we have started a new bull market that started here. So we came out, we broke out. This is kind of your retest move coming back. We're underneath a little bit of resistance right now. And in the short term, we are seeing some weakness, pulling back an upward facing pattern. So think of that as an inverted flag pattern that's heading a little bit lower. But we'll bottom out sometime probably in the fall or something like that. And then I think we're going to give it another run. The reason I'm really bullish on this is it's twofold. LNG takeaway capacity is increasing rapidly in the late 2020s. And then you've got all the electricity demand. So I think the electricity demand is going to be it's going to be pretty substantial. So it'll be substantial enough where I'm pretty bullish on coal. Like I'm
Right.
bullish on other alternatives even like lithium and stuff. Like I think we're going to get squeezed enough and so much demand will come in the late 2020s, early 2030s that we'll be burning everything we can and storing energy with whatever we have.
Yeah, I think so too. I think especially when it comes to the data centers, they're gonna burn whatever they can to get the energy out of everything, out of every square centimeter on the planet. So very well taken there. Before we sign off here, Andy, I also want to get your thoughts on platinum. You're a big platinum bull from the last time we spoke. What's your viewpoint currently on platinum?
Yeah, I would say maintain bullish on platinum. In the short term, we could see a little bit of a pullback. That's fine. But whenever you break these big patterns, this is your big pattern structure there. It's that thing, which is basically the same as this one here. You get this kind of initial surge. We get a big pullback, at least last time. We could get a bigger, big pullback. It's possible, but I don't bank anything on that. If this comes back like that before heading higher, I just stay long. So I think we've got a long runway ahead of us for platinum to outperform. But in the short term, yeah, we're in some sort of consolidation pullback in the very short term. It's consolidating this large upward move, and that's a pretty big move in that
Mhm.
time frame. Was it 50, 60+%? So short term consolidation, longer term, we're going to continue to move on up, in my opinion.
Gotcha. And what about the broad market? Do you see any weakness in the broad market, even though, I mean, albeit we are making new all-time highs?
Yeah, so something like the SPX is continuing to go up. Um, I would, the way that I would have viewed this, I would have said, man, we do look kind of top heavy here. That's the way that I would have viewed it. Looking at kind of a rising wedge coming up into this. There is the possibility that this continues higher. What I would look for is interest rates. If the US 10-year yield does not get above about 4.5% here, I say if they decide to do quantitative easing, or if they are already doing it and not telling us it, maybe, I don't know. If they hold it under 4.5, I think we can continue higher. If this starts to go up and really starts to move above 4.5, above 5%, I think that's going to be a huge headwind for the stock market as interest rates go above this level. Historically, if you look at, say, dot plots, around the 4.5, 5% area is when it becomes a problem for the stock market going on up. So that's what I would focus on if I were you guys, is the 10-year yield getting above 4.5, 5%, and seeing if it breaks through that. Scott Bessent and those guys, I think they kind of said, you know what, when we get to 4.5, I think they kind of come in and do something, buy some bonds or do whatever they need to do. So that's something also to look for.
Well, they began cutting interest rates last year around the fall, and then they stopped sometime in December or late winter. And in that process of them cutting the short end of the yield curve, they actually spiked the 10-year. The 10-year started going up, as Fed funds rate was coming down. And ever since then, they haven't cut anything. And as a result, we've been consolidating vis-a-vis the 10-year. Now you have President Trump trying to get Jerome Powell to cut a whopping 300 basis points or something to that effect. Powell is resisting, whether it's theatrics or not. I don't know. We can only speculate. But if we do get a 300 basis point cut like President Trump wants, what does that mean for the market conditions?
Well, my opinion is the market's going to do what the market's going to do. And if they cut a large percentage, I'm not 100% sure that the 10-year would fall. Um, I think there's a possibility that the 10-year would go up. And if it goes up, that's the market saying, like, you guys are wrong. Like, and it depends how fast it goes up. They could cut rates and it could crash the stock market because the market says, look, if this is the path that you're going to take, we're going to jack interest rates on the back end, which they just sell bonds, which means rates go up, basically signaling that you've got a problem. So I'm not 100% sure that the rates would fall if they were to lower interest rates. And I think that's probably why Powell is sitting there not doing anything, is because I don't know if he can lower rates and get the outcome that maybe Trump and dissent want. Um, if they need lower rates on the long end and they do quantitative easing to get lower rates, which means they're out there buying bonds, getting in the market, what you'd see is you're going to see a weaker dollar be established there. You'll see the dollar drop as they save the bond market or hold the bond market lower. So I'm not in the camp that lower rates is going to equal lower rates. Like lower rates in the short end is not going to equal lower rates in the long end necessarily. I would watch. And if rates spike when they do that, like that's them losing control of the bond market. Like that's the bond market giving a fit. So we'll see. I mean, I don't know what's going to happen. Like if you said, if somebody said, hey, if they're going to lower rates in a week or two, what would the outcome of the 10-year be? I'd be like, I don't know. Like I just watch.
Yeah.
I really
Good.
don't know. And
Yeah.
if it goes up, it's a bad thing. It's a
Mm-hmm.
bad thing.
Which it already did, right? It already did last year when they.
Yeah. So, but if they do it and that rockets, like if they lose, like let's say this goes to like 10%. I mean, like they're playing with fire here. Like the market wants to go up. So this chart here, what this is, I mean, here I'll just back out real quick. This is a long-term downtrend, right? So uptrend, downtrend, and we broke that downtrend. It is done. We are now in an uptrend. And what they're going to do is they're going to say, oh, we're going to jack around with the short end and try lowering rates. It's like, well, what if, I mean, this structure here, I know it looks a little bit ugly because I've got some stuff up here. Let me just delete it so you guys can see it. This structure that's been created, that's a bullish structure. That's not bearish. This wants to go higher, in my opinion. This isn't a structure that's ready to fall. It's not a topping pattern. This is a continuation pattern. It's downward facing. It's breaking higher. This wants to go up. So if they screw this up, if something happens, I mean, they're going to have to get in here and buy a bunch of bonds, but this wants to go this way. So this is a bottoming pattern here. This is an inverted shoulder head shoulder. So if they say, oh, we're going to lower rates, which if the market perceives that as, oh, we're going to print a bunch of money, it's like, okay, well, we're going to sell our bonds on the long end and get the heck out of here. If they sell and it goes up, they didn't achieve what their goal was. Because I think they're trying to lower specifically the 10-year.
I see.
So
Well,
that's where I'm kind of like, I don't know which direction this is going to go.
yeah, and that in itself is a profound statement because in times prior, you could reliably stake your prognosis, the direction of the 10-year on the basis of the Fed funds rate or the short end of the yield curve. But now that is no longer the case. They screwed something up, looks like in 2022 or so, and they've been trying to keep it under control since then. But The cracks on the
So
wall are beginning to show.
if they lose this and it goes above 4.5, 5, the stock market's going to eat it.
Mhm.
Like it's gonna run into a large headwind, and it's gonna start doing this. I think, um, and it could end up pretty ugly. I don't think there's a ton of momentum behind this move in the S&P. This last kind of surge higher here. I think it's vulnerable, is what I'll say. You can see all these small little candlesticks, like it's just kind of dangling out in thin air.
Mhm.
If rates go up, I think it's going to be a rough look for it. I think it's going to roll. So again, I'm not a huge bull here in the S&P and the Nasdaq. I think this could roll over. That's kind of where my mind is, and rates will be the driver of it. If they go lower rates, it's like, oh, don't worry, we'll lower rates, we'll print a bunch of money, we'll print our way out of this debt problem, and rates go up on the long end. I think this is going to go down,
Yeah. Yeah.
and
Fascinating
it looks
stuff
weak.
here. Go ahead.
Yeah, you can see. So we have these big rising kind of wedges here on this whole thing here. Uh, Kind of look at it like this. Like if you were just kind of draw it as one big kind of wedge, wedging up there. Rising wedges are bearish, and we had a pretty good fall here in terms of how fast and how quick that fell. Now we're coming up, and look how small these candlesticks are. Like we're
Mhm.
struggling to get all the way up there.
Yeah.
Um, so I mean, then we're putting in a bearish engulfing today, but I think there's a possibility this could go down, not up. And that's going to go counter to what most people are feeling at this exact moment.
What happens to the gold price and precious metals if that happens? If it comes
Well, I
down?
think it depends on the actions that they take. So if this starts to try to roll over again and they get in there and buy bonds and transfer, if yields want to go up, they buy bonds to hold yields down to hold this up, and then it transfers everything into a weaker dollar. I think the dollar is going to drop like a rock.
Hmm.
So if the dollar, the DXY, this is a relative strength indicator, is what I call it. Right now, it looks bullish to go up, but if they transfer the pressure and we break, like let's say we go up and then we turn back down, and we break this rising wedge in the dollar and go down, we're going to see. I think we're going to see emerging markets just light it up. I mean, they're going to light it up because money's going to start to move away
Okay.
from the stock market in US dollars into other currencies if this were to roll over and pull lower. I think gold and silver are going to light it up. I mean, light it up to the upside. And really, what we're basically charting isn't gold and silver; it's the dollar getting smoked. So it's an asset. 1 ounce of gold is 1 ounce of gold, and 1 ounce of silver is 1 ounce of silver. It's the currency tanking like a rock. So what they're doing is they're saying we've got pressure in the bond market because the bond market. This is the bond market here, real quick. This is a shoulder head shoulder topping pattern. This is the top of that 40-year or 45-year bond market. And this is it selling off and breaking uptrends and breaking horizontal support levels lower. We're in a consolidation here, but we entered this consolidation from the top side down. So we're consolidating, and if this breaks lower, basically what they're trying to do is they're trying to prevent the bond market from breaking lower. They're trying to hold it here and try to get it to come back up. That's inverse to yield. So hopefully you guys are understanding this. Yields go up when bond prices go down, and they're trying to hold yields at like 4.5 or lower. I think that's what they're doing. If they can't hold it, this will break down, and then yields will go up. And I think the stock market, it's not going to like that at all. Um, Pricing in the stock market is very richly valued, overvalued. And when you start playing with the interest rate on the 10-year above 4.5, 5%, all those discounted cash flow models using low interest rates, things start not to make much sense to invest still into the stock market if interest rates were at 5, 6, 7, 8, 9, 10% interest rates. So they're kind of holding the line at the moment, or the market is. I don't know who's doing it, but If that breaks down and rates go up, okay, we'll see what the reaction is. If they say, well, we're gonna bring it back up here, printing billions and trillions of dollars, they're just gonna tank the dollar then. They're just gonna put the relief valve and say, open the spigot, we're gonna drop this sucker. And what have they been saying? What does Trump always say? I think we need a weaker dollar. It's almost
Yeah.
like they know that they have to do this. If we get a weaker dollar, that silver pattern that's sitting on top of all this, it's ready to break. It's right there, ready to run. This thing's it's gonna run. Copper sitting on top of its pattern, it's gonna run. I mean, it's gonna blow because it's the dollar falling out. So that's the way that I kind of view it, and I'm positioned in all this stuff here to take advantage of a weaker dollar out in the future.
It's all coming to a head, Andy. It's very fascinating to
Yes.
watch. Anything else you want to mention, talk about, plug before we sign off here? It's been a great discussion.
Yeah, I mean, if you guys like this and you want to figure out ways to take advantage of our the setups here, you can definitely check me out on findingvalue.com, or you can follow me on YouTube, Finding Value Finance on YouTube, or you can follow me on Twitter, which is finding_finance. But yeah, that's all I've got, Danny. Thanks for having me on.
For sure. Guys, if you enjoyed this podcast, drop us a like and comment. Go, Andy, go in the comment section. If you disagreed with anything, that's fine too. But let me know what you disagreed on and why you disagreed, because I do, in fact, read the comments. So drop me your thoughts down below and subscribe to the channel so you don't miss an episode. And, doing the YouTube stuff really does indeed go a long way in helping boost this algorithm, helping boost this channel in the algorithm, as well as this video. So if you'd like this message to get out to as many people as possible, it certainly does help. And then check us out on Substack at capitalcosm.substack.com, and check out our good sponsors at firstmint.com to get, for all of your for all of your silver buying needs, use promo code CAPC to unlock some pretty cool deals out there. So thanks for watching, guys, and I will catch you later. Bye.